Our tutor will be about capital gain tax. Then what we need to know about capital gain is that you need, after what we are going to cover is to identify the transaction to which capital gain is applicable and apply the framework to calculate taxable capital gain or assessed losses. It can be capital gain or assessed capital loss. So you need to know also how to apply the principle to calculate the proceeds of capital gain tax purposes. We will deal with the proceed to talk more about what proceed consists of. And you also need to apply the principle to calculate base cost for capital gain tax purposes, and also apply the relevant exclusion, the rollover, the limitation, and assessed loss in the calculation of taxable gain or loss. And lastly, you need to apply the inclusion rate to calculate the taxable gain and identify at what point the taxable income calculation taxable gain is included. So about the background, capital gain, what is capital gain? Capital gain tax is on the net capital gain made on the disposal of certain assets. There are certain assets that qualify for capital gain. We'll talk about them. And for your purposes, it's very important to realize that for every asset that is disposed of or sold during year of assessment, the capital gain needs to be calculated separately. You need to calculate separate, you need to do separate calculations for every asset that is disposed or sold during the year of assessment. Then once each gain and loss in respect of each asset has been calculated, then they will be added together. So what you need to do, I'll show you with the examples. You need to calculate for every asset, you need to calculate the assessed loss or gain, and then you add them together and aggregate gain will be calculated. So the structure of calculating the overall structure of capital gain tax is as follows. You do the capital gain for asset 1, and then you do for asset 2 is what I was just telling you, that you need to realize for each and every asset, and then you aggregate. So you will have the capital gain for asset 1, asset 2, asset 3, etc. And then you will have the less, you will less the annual exclusion. Only remember that the annual exclusion will only be applicable to individuals of 40,000. And the aggregate, you will get to the aggregate capital gain or aggregate capital loss, less assessed capital loss that was realized previously, and then net capital gain or assessed capital loss carried over. So we'll do examples. You will see how the structure works, how the structure is done on the example. So the calculation, how do we calculate the capital gain? We start by proceed on disposal of asset, less base cost, you will get the capital gain. For individual, the exclusion is 40,000 annual exclusion, and the taxable gain will be at 40. And other than individual, taxable gain inclusion rate of 80%. So we'll do examples. It will be more clear on the example. So for this asset, we have the following taxpayer that are resident of South Africa. I'm demonstrating by example what I've just said. So in the current year of assessment, or current tax year, they all entered into a transaction which they had an impact on CGT. The details of the transaction is as follows. We have Albert purchased, the taxpayer purchased a dividends earning on 1 October at the base cost of 10,000. He does not deal with shares. He purchased the shares as investment. He sold the shares in 2023 in 31 December 2023 for 30,000. Calculate the capital gain for his 2024 year of assessment. The calculation will be as follows. The following facts are relevant. So the CGT event is the sale of the asset of, that's why we have a CGT, is the CGT event is the sale of his shares. That will be a CGT. So the proceed amount of 30,000 selling price in terms of paragraph 35 of the 8th schedule and the base cost is 10,000 cost price, paragraph 20 of the 8 schedule. So if you want to read more, you can refer to paragraph 20 of 8 schedule for base cost, and also paragraph 35 of 8 schedule for proceed. So you take the proceed, 30,000 less the base cost, you will get to the capital gain of 20,000. So we have again, during the year of assessment, Julie Flavor made a capital gain of 70,000 when he sold her holiday house. And she also made a capital loss of 20,000 by selling her dividends and shares. So calculate the net capital gain for the loss of 2024 year of assessment. So the calculation will be as follows: the gain of 70,000 less capital loss of 20,000. Sum of the capital loss will be 50. The annual exclusion, remember, is an individual, will get to the net capital gain of 10,000. So I was demonstrating what I've just said, but in terms of the eight for the 8 schedule, you need to, the structure will be capital gain less capital losses, and then you less the capital loss as I demonstrate on the question on the solution, less annual exclusion and aggregate capital gain, and then you less the assess loss, and then we'll get to the net capital gain. It's what we just did on this example. So in terms, let's go to the proceed from disposal of an asset in terms of paragraph 35. So for individual, the proceed will be the gross selling price. I just did that with the example. For business, the proceeds are not always equal to the actual selling price received or accrued by the taxpayer. The actual proceeds must be adjusted for any recruitment. Remember that the actual proceeds must always be adjusted to any recruitment and repayment reduction in the proceeds actually received. Therefore, it means the following: adjusted proceed for CGT purpose equals to selling price minus recruitment. When in the case when the donation are made, the transaction are concluded between the connected person, the actual selling price is discarded and the market value is deemed to be the selling price. Where we have the case where the transaction is concluded between the connected person, the market value will be the selling price. But for normal, where there's no donation, normal sales will have the adjusted proceed will be equal to selling price minus the recruitment. Remember, we did capital allowance to calculate recruitment. So you must also refer to that. So how do we determine the tax value? So the first step to calculate the tax value on the date of disposal will be the cost of the price less the allowance claimed. Remember, the allowance claimed, the capital allowance, will get you the tax value. Then the second step is to calculate the recruitment. You set the selling price, let the tax value, you will get the possible recruitment. However, remember this amount is limited to the allowance previously claimed. We did that when we did the capital allowance. So the last step is to calculate the adjusted proceed. You take the selling price less the recruitment, then you'll get to the adjusted proceed. The adjusted proceed amount will be used in all further CGT calculations. So we will do an example on that. So this calculated adjustment cost is then used in further GST calculation. The base cost of the asset is calculated differently from asset purchase before 1st October 2001, which is pre-valuation date asset, and after 1st of October 2001. So the base cost of an asset is generally the expenditure actually incurred in acquiring the asset together with the expenditure. In this level, you will be expected to calculate the base cost to get to when you do the calculation. In some instance, you will be required to calculate the base cost. So what is the base cost of an asset? The base cost of an asset, remember this when you calculate the cost of the asset, which is the base cost. The base cost of asset is generally the expenditure actually incurred in acquiring the asset together with expenditure directly related to its improvement, as well as direct costs associated with its acquisition and disposal of a certain asset pertaining to the holding of the asset. Remember, the base cost does not include, very important, amount allowed as a deduction against ordinary income, such as capital allowance and scrapping allowances. So the base cost does not include the capital allowance and the scrapping allowance. So it's very important to know which cost to include in terms of paragraph 20. You can check on paragraph 20 which costs are included when you calculate the base cost. Remember, again, in this level, in the third year level, you need to know how to calculate the base cost. In some instance, you won't be given with the base cost, you will be given the costs that are associated with the base cost. So you need to know how to determine the base cost and how to calculate it. So it's important to know the costs that which are included in the base cost in terms of paragraph 20 or excluded in terms of paragraph 22 and 3 from the base cost. So what you need in this level, the third year level, you need to know how to calculate the base cost. You need to know the inclusion on the base cost in terms of paragraph 20 or exclusion in terms of paragraph 22 and 23. So remember, the base cost does not include any amount allowed as a deduction against ordinary income, such as capital allowance and scrapping allowance. So we are still talking about the base cost. It's important principle to keep in mind that the costs incurred for an asset that used exclusively for business purposes, for example, repair costs, will probably be deducted for income tax purposes and then be allowed to form part of the base cost. It will be for the repair cost, for example, will be allowed to form part of the base cost. So the following section will deal with the base cost formula. You need to know how to apply the base cost formula. You need to know what is included in the base cost, what is excluded in the base cost. So it means that you must first determine which cost can be taken into account and whether this cost need to be reduced by any amount, for example, capital allowances. So you need to know the base cost formula, the amount to be included, the amount to be excluded, and how to calculate it. So when calculating the base cost, remember on this level, the third year level, you require to calculate the base cost. When calculating the base cost, then that is when required before 2001 validation date. So the value at 1st of October plus paragraph 20 expenses on after or 1 October. So if it was purchased after, if the asset was acquired after valuation date 1 October, paragraph 20 expenses will be included. If it is acquired before that, the market value of an asset, 50% proceed and base cost of the asset. So you need to know when was the asset acquired in order to apply paragraph 20 correctly. So let's do this example. We have Chunk purchased an asset in September 2015 for 10,000. He used it for his own private use. It's not a personal use asset. So during October 2015, he needed to repair the asset at the cost of 1,000. During July 2023, he decided to sell the asset and incur the following expenses. So these are expenses that incurred when he was selling: agency fees, advertising fees, and cost of transportation to the buyer at 300. So he received 15,000 from the buyer for an asset. So I want you to take 5 minutes and go through and try to calculate the capital gain or loss. I want to see if you can apply paragraph 20 on this question, and then we'll continue at 25 plus. So we have Chang purchased an asset in September 2015. Remember, we said the asset acquired before valuation date, which is 1 October 2001, and the asset acquired after October is paragraph 20 expenses. So this asset is acquired after 20 October, after 2001 in October. So we apply the paragraph 20 expenses. So how do we do that? The asset was purchased for The asset was purchased in September 2015 for 10,000. He used for own private use. During 2015, he needed to repay it at the cost of 1,000. During July 2020, he decided to sell the asset, which is 2024 year assessment. And he incurred the following expenses: agent fees, advertising cost, cost of transport to buyer. He received 15,000 from buyer from a buyer as an asset. The calculation is as follows: proceed 15,000, which were given, is the selling price. He received 15,000 is the selling price that he received, less base cost, which is the base cost. We needed to calculate the base cost. What is the base cost of the asset? The base cost of the asset in terms of paragraph 20 expenses will be the acquisition cost, which is 10,000, which were given. Agency fees of 500 is included. Advertising cost is also included. Transport cost is also included. And repair cost is not included, is not allowed in terms of paragraph 22 of the 8th schedule. So we applied both paragraph 20 and 22. So we got to 111,200 as the cost of the asset. So again, the base cost in this level, we need to calculate the base cost. In some instance, you won't be given the base cost, and this is how you calculate it in terms of paragraph 20. The acquisition cost will be included. The agency cost, the agency fees will be included. Advertising cost will also be included. Transport cost will be included. Repair cost will not be included, will not be allowed in terms of paragraph 22. So it will be 0. So we go to the base cost of 11,200. So proceed less base cost, it will be equal to capital gain. The proceed, the selling price we were given of 15,000. We calculated the base cost at 11,200. We got to the capital gain of 3,800. Remember, the annual exclusion is 40,000, but it must be limited to that. It will be limited to the capital gain, which is 3,800. Aggregate gain will be 0. So on this question, remember the two things: the paragraph 20 expenses, the paragraph 22 exclusion, and the annual exclusion of 40,000 to individual. And also it must be limited to the capital gain, the annual exclusion. So any question before we move to the other one, to the next slide? Do you have any question before we can move to the next slide? Any comment, any discussion? We're applying paragraph 20 and paragraph 22. So let's move. So we have primary resident exclusion, paragraph 44 to 50. You can go through that. The personal use of asset, paragraph 53. You can also go through that. Disposal of a small business asset, paragraph 57. You can also go through that. So the exclusion of primary, let's go to the primary residence. Some will have the instance where the taxpayer is selling the primary residence. And how do you calculate the primary residence? In terms of paragraph 45, go through the paragraph 45. The rule is that 2 million gross is the gross rule. The proceed must be, you need to go through paragraph 45 to be able to apply to learn more about the primary resident when the taxpayer selling a primary resident. So The proceed, if it's less than 2 million, any capital gain will be disregarded. If the proceed is less than 2 million, the 2 million cost rule, remember, in terms of paragraph 45. So the exclusion of primary residence. So we'll have the instance when the taxpayer sell the primary resident. What you need to know, you must ignore the transfer of a resident from a company to a trust. So if individuals sell this resident, the primary resident, the taxable gain or loss, the capital gain can be reduced by applying paragraph 44 to 51. So the natural person can claim provision of 2 million exclusion in terms of paragraph 44. So if the property is larger than 2 hectares, only the first 2 hectares qualify for primary resident exclusion. If the portion of the property is a primary resident, but a portion is used for business purposes, remember, if you use the asset for business purposes, you can claim deduction on that. That portion will not qualify for a primary resident exclusion. If the proceeds are 2 million or less, then any capital gain calculated or disposal of the primary is not taken into account. So what you need to know about the primary resident, the primary, you must first ignore the transfer of primary resident from a company or a trust. So in case where individuals sell the primary resident, the taxable gain can be reduced by applying paragraph 44 to 51. So if a natural person is liable to claim 2 million exclusion, can claim that he qualified to claim the 2 million exclusion. If the property is larger than 2 hectares, only the first 2 hectares may qualify for primary resident exclusion, will be given the number of the hectares. So if a portion of property is used for business purposes, remember every time when we have a portion in your primary residence that is used for business purposes, you'll qualify for section 11A deduction. So the proceed, if it's less, is 2 million or less, then capital gain will not be taken into account. So the exclusion is not applicable where a person, where individual person, taxpayer did not reside in the house for the full period, where the portion of the resident was used for trade purposes. Remember, a trade qualifies for section 11A. It won't qualify for primary resident exclusion. So the maximum amount of exclusion is 2 million, but if one of the exception exists, that portion of capital gain does not qualify for the exclusion. Remember that the maximum is 2 million. So if the running cost of the house is claimed as a business expenses, is claimed under section 11A for income tax purposes, that portion of capital gain on disposal does not qualify for exclusion. Remember, if you were running the house, if you had the business expenses and part of the portion was used for business purposes, was used for trade, it will be section 11A. You will qualify for that deduction. You won't qualify again for primary resident exclusion. So the reason of the rule listed above is that there may be overlap of 2 years, resulting in a person having 2 primary residents at the same time. So you must take into account the first thing, the exclusion will be applicable to person residing in the house for the full period where the portion was used, did not reside in the house. The exclusion will not be applicable where the person did not reside in the house for the full period, or where the portion of the resident was used for trade purpose. Why it's not applicable? Because the taxpayer normally will have been qualified for section 11A, which is deduction. The trade will qualify for deduction. The maximum amount of exclusion is 2 million, and the running costs, which are claimed for business purposes, section 11A deduction was claimed by the taxpayer before, as business expenses for income tax bill, that portion of capital will also be excluded. So if the person, remember the exclusion, we have 2 million as exclusion, but the exclusion does not qualify where the house was used for trade purposes or where business expense were claimed, because section 11A, the taxpayer qualified for section 11A, and the deduction was made on that. And another thing is where the taxpayer is having two primary residents at the same time. For example, we have George sold a primary residence for 4 million during the current year of assessment. The base cost is 1.2 million. So calculate the capital gain on disposal of primary residence. The proceed is 4 million, 4M divided by 120 is 280. Then less primary exclusion of 2 million. Then capital gain on disposal will be 800,000. So it's a simple calculation. So we have another example where George sold a primary residence for 3 million. During the year of assessment, the base cost is 120. It's 1.2 million. So calculate the capital gain, the proceed less base cost less primary. You see, they got 180. So the less primary resident exclusion there must be limited to 2 million. So it's 0. You must apply the limitation. So adjusted of 2M exclusion, limitation on the size of the land, not ordinary resident throughout the period, part of the resident used for trade purposes. So if the part of the resident was used for trade purposes, it qualifies for section 11A. So one is excluded on the 2 million will be excluded. Limitation of the size of the land. Remember, we also have the limitation on the size of the land, where the land on which the resident is situated is less than 2 hectares. So 2 million exclusion only apply to the portion of land that is used mainly for domestic purposes. So let's start again. The exclusion on primary resident, we have the limitation on the size of the land. Remember, you must remember this limitation on the size of the land, because you need to calculate it by the size of the land. Where the land on which the resident is situated is greater than where the land on which the resident is situated is greater than 2 hectares. 2 million exclusion will only apply to portion. You need to calculate this portion that is excluded. The 2 million excluded will only apply to the portion of the land that is used mainly for domestic purposes and disposed of the same time as resident for trade purposes. So what you need to know here is that we have the limitation on the size of the land for exclusion. So where the exclusion applies to where the resident is situated is greater than 2 hectares, and 2 million will be divided. So we will see that with the calculation, but it's the portion, after you divided the portion of the land that will be used for mainly for domestic purposes and disposed at the same time as resident. It must be disposed at the same time as the resident. So we'll do by this example. This sold his small holding for which he is used as a primary resident. The selling price was split and was divided as follows. 500 house, it was for the house, and 3 million for 10 hectares land. So the house is situated on the land, was used for domestic purposes. So the base cost of the house is 300,000. and the land is 100,000. It's 1 million, so the land is 1 million. So what we have here, what I want you to remember when we do this question, I want you to try it on your own, and then we will discuss it. So we have a limitation, we have exclusion of 2 million. So adjustment to exclusion of 2 million is limitation on the size of the land. So part of the resident must be used for trade purposes and not ordinary residence throughout the period. Is the limitation applies to this. So the limitation, adjustment limitation will apply to limitation on the size of the land, not ordinary resident in the Republic throughout the period, and part of the resident used for trade purposes. Is only this situation. So limitation on the size of the land, where the land in which the resident is situated is greater than 2 hectares, and the 2 million exclusion will apply to portion of land that is used mainly for domestic purposes and disposed of the same time as resident for trade purposes. So in this situation, the house is situated at the land, and remember the land is 10 hectares and the house is 500,000. The house is situated on the land that is used for domestic purposes. So the land must be used mainly for domestic purposes. And the other thing, the rule, that it must be disposed at the same time as the resident of a trade, as the resident and for trade purposes. So here, the house is situated in the land and was used for domestic purposes. The base cost is 300 and the land is 1 million. So calculate the capital gain loss on disposal of a property. What I want you to do is to calculate the capital gain loss on disposal of a property, and then we'll discuss. I'll give you 10 minutes because I want you to think before you calculate the base cost and you calculate the proceed, and then we'll take it from there. When you do this question, you must remember the adjustment and also the limitation. When you calculate the capital gain, the limitation of 2 million, how to apply the limitation. So please do this and then we'll discuss it. Anyone who wants to try the answer? We have a taxpayer who sold his small holding in which he used as a primary resident. He sold a primary resident. The selling price was split as follows: a house and a land, 3 million for a land, 500 for a house. The house is situated on the land that is used for domestic purposes. The base cost of the house is 300,000, and the land is 1 million. So how do we have the base cost, we have the selling price. How do we calculate, how do we calculate the exclusion? The 2 million, how do we portion the 2 million to the land and the house? Remember, is situated, where the land on which the resident is situated is greater than 2 hectares, the limitation of the size of the land. So let's go to the suggested solution. So we have proceed, which is given. The selling price is 503 million, which we were given on the question, less the base cost. So the base cost we are given, the gain was 2 million, the other one was 200,000. So total gain, you add the both gain and then you get 2.2 million. So less primary resident exclusion. I wanted you to apply what we just, the limitation on the exclusion. So the house is 2 million. The house is 200,000 plus 2 hectares. Is limited to 2. Remember, they said the limitation is 2. It must be limited to 2. So we have the 2. hectare on the land is 2 million for the land times 2 divided by 10, which is 40, is 400. Then the primary resident exclusion will be 600,000. And the capital gain on the loss will be 160. Anyone who calculated differently from me? So let's go to the exclusion. In terms of paragraph 53, please go through this paragraph that I mentioned on your own time. In terms of paragraph 53, 54, 55, all these paragraphs that are mentioned here, please go through them. They will be talking about the exclusion. The other exclusion will be a personal use of asset. A personal use asset is an asset that is used mainly for the purpose other than conducting a trade. A small business exclusion is limited to the maximum of 180 million during the period of a long time, but all the requirements must be met in order to claim the exclusion. The exclusion for long-term insurance policies does not apply to the disposal of long-term insurance policy abroad or disposal of a second-hand long-term policy. So the other exclusion, in terms of paragraph 57, please go through paragraph 57. Only it will be applicable to a natural person. The exclusion will be applicable to a natural person and held for continuously if only the natural person disposing, it will be applicable to natural person disposing an active business asset only if the exclusion held for continuously period of equal or greater than 5 years prior, and then natural person must have been involved in an operation of small business. A natural person, remember, we are talking about the exclusion. It will only be applicable to natural person disposing an active business asset. He qualified if the asset was held for continuously periods of greater or equal to 5 years prior. And natural person, the other one, the natural person must have been involved in the operation of a small business. The other exclusion is where the natural person is either 55 years or older, or disposal was in consequence of ill health, other infirmity, and supernatural or death, is where the exclusion will be applicable. So the personal use of asset, natural person, is disregarded capital loss or disposal, and then any asset used for purpose other than carrying of a trade, the exclusion will be applicable in this case. So remember that the capital loss in respect of a certain asset must be disregarded in determining a person's aggregate capital gain or aggregate capital loss. Remember that the capital loss in respect of certain assets must be disregarded. The capital gain, the capital losses in respect of certain asset must be, remember, is in terms of paragraph 15, 19, 39, 56, and 83. You must go through them. For the limitation of losses, remember that the capital losses in respect of a certain asset must be disregarded in determining a person's aggregate capital gain or aggregate capital loss. We did example on aggregate capital gain, and it's important to know that the term explained above and to distinguish between them. We must distinguish between the certain asset that must be disregarded in determining the percent aggregate gain and aggregate loss. You must also use the correct term at the correct place in the capital gain tax framework when doing the capital gain calculation. So you must know where to include the capital gain or capital loss when you do the capital gain tax calculation. So the aim of this rule is to defer capital gain to a certain situation when the asset is disposed involuntarily in terms of paragraph 65, you must go through paragraph 65 is the rollover of capital gain in terms of paragraph 65 and 66 and 9HB is the rollover of capital gain. You must go through this paragraph. So the aim of this paragraph is to defer the capital gain in a certain situation. For example, when an asset is disposed of involuntarily, it will be in terms of section 65, and when it's being replaced, it will be in terms of paragraph 66. So you need to read paragraph 65 and paragraph 66 and 9HB. It will be these rules of rollover of assets. The aim of this rule is to defer capital gain in a certain situation. For example, when the asset is disposed involuntarily in terms of section 65, and when the asset is replaced in terms of section 66, with the result that the capital gain is rolled over until the replacement of asset is disposed of. So you need to know the paragraph 65 and paragraph 66. So the requirement is important because they determine when the rules should be applied. So you must know the requirement for you to apply the rules correctly. So if all the requirements are met, capital gain will be taxed as follows. Capital gain for involuntary disposal will be in terms of section 65. You need to go through it and understand it for you to apply the correct rule. So in terms of if the requirements are met for section 65, capital gain will be taxed as follows. Capital gain on involuntary disposal, section paragraph 65 of an asset, and that is then replaced by non-depreciable asset. So the capital gain is taxed when the replacement of asset is disposed of. Capital gain involuntarily or involuntarily of an asset is then replaced by depreciable asset. So we'll go through the example to see how the rollover will be applied in the question. So the capital gain is recognized as the same ratio in which the capital allowance is granted in respect of the replacement asset, and therefore taxed in the full tax year. So this means that dividing the capital gain will be taxed from the year that the replacement assets has been brought into use, and capital allowance can be claimed on it. Remember the capital allowance in terms of capital allowance, we did the capital allowance calculation. So this means that the capital gain will be taxed, the division of capital gain will be taxed from the year that its replacement of asset has been brought into use, and capital allowance can be claimed on it. So there are rules for capital gain allowance. We did that rules. For example, so we'll do this example in the next lecture because we are left with 2 minutes. So we'll do the rollover. On Saturday, we'll do the rollover of capital gain, and also we'll do the rollover and the calculation and merit increment of property. We all know that if we'll start with the example of rollover, then I will recap on what we did. And then we'll also talk about merit of community of property. Yeah, this example is too long. We'll do it on Saturday. So we'll do the rollover. I will recap on what we have done, and then do the rollover, and then do the other examples on Saturday. So do you have anything that you want to add or any question on what we did? But I'm going to repeat this lecture on Saturday. I'm going to recap on what we have done today and also do the rollover example on Saturday. So any question on today? I have missed some concept on primary resident exclusion limit and application. So this I will do it on Saturday again. Okay. I know I was very fast maybe, but I'll do it on Saturday and we'll do some example. But I'm going to repeat what I have learned or what I have done today on Saturday.
No problem.
Okay. Thank you. I know today it was more on theory, but on Saturday we'll do more practical example. And then don't worry, I will repeat the primary resident exclusion and do the example again and the rollover.